So without much ado, I would now pass on floor to Professor Badhani and welcome you all to this exciting session. Professor, over to you.
Good afternoon, everybody. Welcome to this session. So today we will discuss the different issues involved in the valuation of green business. I request you to pay attention to this example. Just a minute. So there are two very well-known companies, globally well-known. One is Toyota, a very old company, a well-established name in its sector. Today's its business is around $305 billion. Another is Tesla. It's a new company. Its current business is around $98 billion. But if you look at their market capitalization, Toyota's market capitalization is today $250 billion, while the market capitalization of Tesla is $1,450 billion. So despite of lower business volume, the valuation of Tesla is much, much higher in comparison to a well-trusted, a old company like Toyota. So what explains this difference? What makes Tesla so valuable in the market? So I will like to get a quick response from your side. What do you think? Anybody? Yeah. Anybody want to participate in the discussion? Okay. So you may hold this. Okay. Anybody who want to participate can unmute and can speak up, right? So you hold this discussion, this question. Please bring in. Please keep this question in the mind. We will continue this discussion on this question later also. But before we do this, let us come to this question. Whenever you hear about valuation, what comes to your mind? What is valuation? What the valuation is all about? What comes to your mind first when you think about valuation? Any participant? Anybody? Is the valuation all about mathematical models? Or it is about filling complicated spreadsheets? So let us first try to understand what the valuation is intuitively. What is the meaning of valuation? What is the intuitive meaning of the valuation? So I will like to take to you to an example which will be very close to the heart of everybody, all of us, because all of us have agricultural roots. If not in this generation, in the previous generation or 2, 3, 4 generations back, we all of us have migrated from agriculture, right? So let us take this example. Suppose there is a farmer and he want to take some land on lease. So suppose 1 hectare land on lease. And this lease will be for 1 year. 1 year's lease. So the land is available. Some other farmer is there who want to let out the land, 1 hectare land. But there are many people who are interested to take this land. And this farmer is thinking to grow sugarcane in this piece of land. And you might be knowing, in 1 year, we can get only one crop of sugarcane. Okay. So he has to pay that rental right now, pay now, and he will have to wait for 1 year. He will grow the sugarcane, and after 1 year, he will get something. The question here is how much he will bet for today, how much he will bet, what should be his bid. Now, in deciding the weight, the farmer will think the weight should not be too low. If it is too low, then there is very less chance that he will get this land. And he will remain unemployed. He will get lose an opportunity to earn something. But if this bid is too high, he will get the land. But in that case, he may end with having loss because the rental may be much more higher than the money he get at the end. So I think you are aware of this phenomena, which is known as in game theory and other literature, we call it winner's curse. So he has to decide what should be the bid amount, how he will decide. It should be neither too low nor too high. So how he will decide the bid amount? Now, I want your active participation, please. So if you are at the place of the farmer, then how will you decide this? Any participant? Anybody? What are the factors you will consider? Okay, if you know financial modeling, can you answer this question? Do we need financial modeling to answer this question? Most of the farmers are not aware of financial modeling. They may not have learned spreadsheet modeling. Or can we answer this question using some mathematical models? No. How we can answer this question? We can answer this question only if we understand the sugarcane business, if we know something about farming. If you don't know anything about farming, you cannot answer this question. So you should be aware of what happened in farming. What are the inputs we need? And how much we get after 1 year? What is the yield of the sugarcane? What is the market price of the sugarcane? And what are the different costs we have to pay? Then only we will get to know how much I am going to get at the end of the year. So, to answer this question, the most important thing that we need is the understanding of the business, the basics of the business we want to value. So, if we have to answer this question, we will have to do something like this. So, we have 1 hectare of land. So, the yield of sugarcane in the land is around 800 quintal per hectare, and the market price is somewhere around 355. So, at the end of the year, we will get total revenue of 2,84,000. And then there are different costs. Suppose these are the cost. I have taken most of the cost based on the available information and research papers. So the total cost is of cultivating sugarcane in 1 hectare of the land in Western UP is coming 1,79,000. So at the end of the year, he will have a surplus of 1,04,000. Now, how much he can pay? If he is getting 1,04,000 at the end of the year, how he will decide this? So one way to look at this problem is he will think, okay, if I have some money and I put that money in the bank, in FD, how much return I will get? So every return is 6.5%. But you can get this money, FD interest, without any botheration, without any risk, without any pain. While in sugarcane farming, you have to spend your time, your energy, your emotions, everything. And you are taking a lot of risk also because you are not sure what kind of the weather will be there. Will the price will remain to 355 or not? Or yield may come down. There may be some kind of the disease. So you are taking a lot of risk. So if the returns are only 6.5%, it is better to put your money in FDs rather than investing this money in agriculture business. So he will ask for something more over 6.5%, something to compensate for risk. How much? It depends on the amount of risk. More the risk is, more compensation the investor will ask for. Now, agriculture is very risky business. And moreover, the risk involved in agriculture is very different from the risk involved in business. For example, portfolio investment, where you can diversify agricultural risk. There are very low chance to diversify your risk. So a lot of risk the farmer is taking, and he will ask for some compensation. I have put the figure 10%, which makes it around 16.5% or 17% return, what he will demand for. So this is the minimum rate of return. What the farmer is saying, if I earn 17% return, then only I will enter in sugarcane farming. Otherwise, there is no sense in doing this business. So now the question is, what investment will make a money equal to 1,04,192 if the returns are 17%? To answer this question, we will have to discount this 1,04,092 to present, which is coming 89,000. So 89,000 should be the lease rental. And if I have conducted some online survey, online search, what is the lease rental generally the farmers are demanding in Western UP? So depending on the location of the land, this is 75,000 to 2 lakh rupees per annum. So this 90,000 valuation comes within the range, particularly the lower range of this figure, because we are talking about only agricultural land, not a land which can be used for some other purpose like, real estate. So what we get from this particular example, what is more important about valuation? It's not a spreadsheet, it's not mathematics, it's not equations. More important thing is to understand the business. Okay, now here we talk only about 1 year's business. If it is multi-years business, what will happen then? So suppose you are taking this lease for 5 years, then how you will decide what value you should pay today if this is 5 years lease? Then you will discount this 5 years of cash flow, 5 years of surplus today using the required rate of return. So if the 17% is the required rate of return, then every figure is discounted for the number of years you will have to wait to get that cash flow. So the first year's cash flow is discounted to present is getting 89,000, and second year, third year, fourth year, and we sum it. This is the valuation for 5 years of the rental. If you want to buy this land, then how much you will like to pay for it? So suppose you are cultivating sugarcane forever up to infinite in the same piece of land, and you get same amount of cash flow here, then the valuation will be, we use this formula, which is an infinitive series, and we get the solution, cash flow divided by the required rate of return. So the valuation will be 6,12,895. But I think it's a little bit understated because the 17% required rate of return may also include the compensation for inflation. While the surplus, we have taken the same amount, we are not including the growth caused by inflation. So more consistently, rather than using 17%, we should use the real rate of discounting, which is before taking into account the inflation element. So I subtract 6% inflation from here. So the valuation is coming somewhere around 9.5 lakh. And my online survey says that the piece of land which is remotely located, 1 hectare land is available in Western UP at around 7.5 lakh to 35 lakh is the upper limit. So this is how the valuation can be done. So this is a very simple example which highlights one fact. What fact it highlight? It highlight very important fact that to understand the valuation, the most important thing is to understand that business rather than going more into mathematics and spreadsheets. And what we need to understand about the business? We need to understand how much this business is going to earn for us in the future. And that will be decided by what kind of the input, what kind of the technology is going into that business, what kind of the market is there, what is the size of the market, how much is the competition there, what kind of the demands are there. Using these factors, we can decide how much growth is possible and what kind of the revenue stream this business can generate for us in the future. And from the revenue, we have to calculate the cash flow, first profit, and then the cash flow. To calculate the cash flow, we should know how much is the margin, what are the costs, and what are the margins, and how much profit is available there. But we also need to calculate how much more investment we will have to put in the business to generate that cash flow. And that depends on how efficiently we are able to handle the capital or the investment, how efficiently we can convert our investment into revenue, which is called the capital efficiency. And then the discounting factor, as I highlighted, the required rate of return, which we use to translate our future cash flow to the present, that is dependent on how much risk is there in the business, what can go wrong in the business. So if we consider these factors, okay, these are the important factors which are used for the valuation of the business. Okay, so what we are going to do today, we will discuss the valuation. We will start with the traditional valuation approach, of course, but very quickly we will discuss them. And then, since our focus is going to be the valuation of green business, we will focus on green business more. But you know, most of the green business are startups. So before we talk about the green business, we will also discuss about what kind of the challenges we face when we have to value a startup. We will use one example or the cases also to highlight our points, and finally we will have a question answer session. But I request you to make this presentation more interactive. If you have to say something, you have to add something during the discussion, during the presentation also, you can contribute. Okay. So what will be our perspective, who we are, from whose point of view we are talking here? We may take two different roles. Either we can take the role of a green entrepreneur who is going to start a business, a green business, and interested in knowing how much finance we can get for this business, what will be its valuation in the market. Or we can take a role of an investor, like an angel investor or a venture capital fund or a private equity fund, these investors who put their money in these startups. So either role we can take, we will discuss from both the perspectives. Okay, so green business, what is the what is our idea about green business? So I'm not going into academic details to define the green business. For me, the green business is something which provides us environmental or climatic benefits like renewable energy, solar, wind, hydro energy, electric vehicle, for example, batteries, storage, recycling or circular economy related firms, carbon capture and clean technology like businesses. Why these are different? Why we should talk about these firms separately? Why they are not covered by conventional um, uh, valuation models? There are few things which make these firms very different. First, they are heavily dependent on policy and regulations. And these policies, regulations are evolving and changing very fast. So our assumptions about the calculation of our future revenue and the cost and the cash flow depends on our assumptions about the regulatory policies. And any change in these policies may change the valuation. Number two, these are the businesses where we need a lot of investment at very beginning, and the gestation period is very long, and we are not very sure when exactly we will start making the money. Third, as I pointed out earlier also, to the very large extent, our revenue model depends on what kind of the subsidies we are getting from the government side, or what kind of the carbon credit or other kind of the positive benefits are available there. Next, uh, the cost of capital. Now, cost of capital, there are both the factors. So there are pull factors, push factors. There are the factors we will bring the cost of capital or the risk down. There are various ways how green business help us to mitigate the risk. But at the same time, there is huge uncertainty associated with green business, which push the discount rate upside. So we will try to debate here the sides of the green business. Okay, and the way the society look at the ESG performance, the positive sides as well as the uncertainty or skepticism, that also impacts the valuation. We will discuss these factors also in some detail. So first, I will rush through the traditional valuation model. My understanding is most of our participants here understand the traditional valuation models. I have already highlighted in agriculture example how the valuation done in the traditional way. So there are different methods like discounted cash flow method, relative valuation method, asset-based valuation methods, which are used for the valuation of the traditional business. So if you are getting a single cash flow, for example, in agricultural, our example of agriculture, so we simply bring that future cash flow to the present. Now, look here, the most important thing is valuation is all about the futures. So, the biggest challenge in valuation or any decision making situation is a talk about the future, and nobody has seen the future. Future is subject to uncertainty. So that is the most or the biggest challenge that we have to, we have to try to foresee that future, which is very difficult thing. Okay, if we have multiple cash flows, as in the example we saw, we can discount them to the present. But this model may look very complicated unless we make some assumptions about the nature of these cash flow. And one of the simple assumption that we make is, suppose this cash flow is constant through the life. If this cash flow is constant through the life, then valuation model simply becomes cash flow divided by the required rate of return, as we used in this Excel sheet to decide the value of the land. Okay, so if the same cash flow is repeated up to infinite and we have a discount rate, then we can simply value the land by dividing 1 year's cash flow by the required rate of return. So this is the most simple, model of valuation. But since this is not applicable in the business situation because business have some growth potential, so then the second assumption we make is suppose the business is growing at the okay, sorry, I did not put the growth here. So the business is growing at the constant growth, then this equation will converge into the first year's cash flow divided by rate of return minus growth. Now, here the importance of the growth is very, very crucial. You change this growth rate by a small friction, there will be huge change in the valuation. So I can give you one example. Suppose there is a business who is generating right now 1 lakh rupee of cash flow. Suppose the required rate of return is 12%, and suppose the growth rate is 6%, then the valuation of this business will be equal to 12% minus 6% here. It will be 16 lakh. But you change this growth rate little bit. You make it 7, it will become 20. You make it 8, it will become 25. So you see, the valuation is very highly sensitive to the growth. And therefore, the most crucial question that we have to ask about the valuation in the business is how much growth will take place in the business. Now, another kind of the situation where there may be multiple growth phases, and this is most relatable, most practical kind of the assumption, where the business will grow at the some rate, at a high rate for some time, and then it will grow at a lower rate after that point of time. So this has a terminal growth which is lower and a high growth phase which is higher. So let us take one example here. Suppose there is a business which is giving us present cash flow of 10 crore. But this cash flow is likely to grow by the 10% every year for 5 years. Then after that, it will grow at the rate of 3%. So there are on two phases, two-phase growth is there, the high growth phase and the sustainable growth phase. So for the high growth phase, what we can do, we can calculate the cash flow and discount them to present using the same method that we discussed earlier. We can discount them to present and then add it. So this is the valuation during the high growth phase. Then after 6 years, it is likely to grow at a sustainable low growth. So 3% is the growth rate. So now if we value it for the rest of the life at the constant growth, so we will use this formula. So the cash flow divided by 10% growth rate minus 10% discount rate minus 3% growth rate. So its valuation at the beginning of 6th year is 366. Now we translate this up to at the beginning at today at t equal to 0. So we discount it for 5 years. So this is the present value of the sustainable growth phase. So the total valuation of this business is 292. Out of this, 227 is coming from this sustainable growth phase, the constant growth phase, and only 22% is coming from the high growth phase. So graphically, if you see it, so the contribution of the high growth phase is not that crucial. The contribution of the sustained growth phase is highly crucial, more important. So the relevant question that we should ask about the valuation is, when this business will become mature, at what rate it will grow for the rest of its life? Here, the assumption is this business will grow at a constant rate forever. If you are not, satisfied with this assumption, for example, you see the life of the business is not infinite, it will terminate at some point of time, then this model cannot be used. Rather, you will have to then discount all the cash flow throughout its life to present. Okay, so this is the most important question. What is the sustainable growth that business can achieve in the future? Okay, generally for practical purpose, what we do the valuation using two different methods. Either we calculate the free cash flow for the firm and do the firm valuation and then deduct the value of debt to find out the value of equity. Or alternatively, we do what is known as free cash flow to equity based valuation, where we calculate the free cash flow which is available for the owner of the business and then discount it using cost to equity. So these two different methods are practically used. If the company has used debt, then the first method can be used. If the company is relatively debt free or it has low leverage, then the second method is used. For my classroom, I have prepared an example where we do the valuation of ACC Limited. So this is the recent profit and loss account of ACC Limited, but I am doing the analysis for ACC Limited for multiple years here. So I have calculated what kind of the revenue growth the ACC has achieved during the last many years. And look here, now ACC is a cyclic kind of the business, so growth rate may go up, may come down cyclically, but we are more interested to know what is the sustainable growth rate, what is the long-term growth rate. So that growth was around 10%, and the EBITDA margin was around 15%, and capital employed to sales, what is known as capital employed turnover ratio, it was around 1.25%. And we think that this business model, since a mature business model, it's not going to change much in the future. So we use these factors to value the ACC Limited. First of all, what is should be the required rate of return for ACC? Since ACC is kind of the business which is cyclic, which moves up and down with the market, with the economy, its beta is almost one. Thus, beta of cement industry is also one. So we calculate that its required rate of return will be somewhere around on the same line as the market returns are around 11 to 12%. So I have assumed it's 12%. And this is the free cash flow based calculation. So in the valuation, generally we should be a little bit conservative. So rather than using 10% growth rate, I am using 9% growth rate, and then terminal growth rate after fifth 5 year around 7%. I am using 15% EBITDA margin and tax to EBITDA ratio of 16% and capital employed turnover ratio of 1.25. So using these figures, I have calculated how much sale is possible and what EBITDA the company will earn, how much cash flow will be saved after tax, and how much investment company need in the form of capital employed, how much additional capital employed the company need, and what will be the free cash flow to the firm. So this free cash flow to the firm is the after tax cash flow plus or minus additional capital employed the company need. So this is the future cash flow, and then we discount it to present. After 6 years, I calculate the terminal value. So that adding these two together, this is the valuation of the business we are getting. 38 crores, 38,000 crore. And then I add the cash reserve which the company has to this valuation. This is the valuation of the enterprise. There is no debt. In fact, it's a debt-free company. So the entire valuation is going to the equity. The number of equity shares are 18.77 crores. So that's why the valuation of ACC is 2,187. Right now, it's trading at somewhere around 1,800, 1,900. So after 1 year, sorry, this date is not correct. After 1 year, this is going to be the valuation. The same valuation we can reach using, yeah, this is the calculation part, using what is known as the relative valuation method. Relative valuation methods are the quick way to reach at the valuation, uh, where we link the valuation to something like earning per share, dividend per share, or cash flow per share, or EBITDA, or the sales. This kind of the valuation multipliers are more suitable for the mature kind of the business. So since ACC is very mature business, so we can find out the valuation of ACC using relative valuation also. So one of the very popularly used valuation metrics is P ratio. So if we look at the P ratio mathematically, it can be approximated as P ratio is approximately equal to 1 upon the required rate of return minus the growth rate. So using this formula, if we go to ACC, ACC's P ratio should be somewhere around 20. Why 20? Because as you can see here, the required rate of return for ACC is coming 12%, and the growth of 7%, sustainable growth of the 7% we had projected. So 12 minus 7% is the 0.5, 0.1 upon 0.5 is 20. So I think for ACC, 20 is good multiplier. And average multiplier in the history of the ACC is also 20. So now we project what will be the per share earning for this company in 2026 using past data, and then extrapolating them. I have reached at this figure. 107 rupee is going to be the per earning per share. We multiply it by 20, so I'm getting 2,114. So these two valuations are very close to each other. And right now it's trading at 1,884. So there is, we can say, 15% upside possible in 1 year. Okay, so these are traditional methods. But what is unique about these traditional methods? These methods are designed to value those businesses which are established, which are mature. These cannot be used for valuation of the startups. But since we are talking here about the green business, and most of these green businesses are the startup businesses. So how the valuation in the startup business is different? So what are the challenges in the startups? So I hope now you people have spent some time in the class. So now you can participate. What do you think? What are the challenges in the startup business? Can anybody? Will anybody like to answer this? How the startup valuation is different from the valuation of the traditional matured business? Nobody is there interested to speak up?
The people are sending their response in the chat.
Okay. Chat. Right. Delay in policy making. Okay, Professor, you have got one question from P. Kumar. What if the profit percent is high and the payback is short? Actually this P ratio is calculated for the kind of the business which are the matured business, and in the mature business that kind of the growth is not possible. If the growth rate and payback is short, okay, profit is high, payback is short, like, okay, so polymer business, yeah, that can happen. Payback may be short. Payback may be short in the business where the investment is low and the profit may be high. Yeah. Got to the question. You can drop any time. Okay. Right. Uncertain growth rate. Yeah. Delay in policy making. Investment. Yeah. Future projection is difficult in the case of startups. Very right. Very right. Correct. So, startups. Actually, when I discussed with you ACC, I had a long history of ACC. Although the history cannot replace the future, but history can give us some comfort to make valid assumptions about the future. Startups has no history. Therefore, we are very uncertain about what kind of the future they will have. We don't know the kind of technology they are talking about, whether this technology will work or not, or the kind of the market they are talking about, where will that market will be really existing or not, how big the market is, and what will be the kind of the response from the competitors, and kind of technology they are talking up today, how long that technology will sustain when the new technology will supersede that technology. So there are a lot of uncertainties associated with the startups. So this is what the startup face. No operating history, very high uncertainty, and we are totally based on intangibles. So they do not have tangible investments like ACC has factory, ACC has huge balance sheet. They depend on innovations, they depend on intellectual properties, they depend on their founder quality, and in most of the cases the founder may be the first time founders. They do not have any history. So so these are some of the reasons what make the startup valuation very, very challenging. Although the basic idea of the valuation will not change, still the valuation depends on the same kind of the questions. How much money they are going to make for their investors in the future? What will be the future cash flow? What will be the growth? What will be the revenue? What will be the cost? And what kind of uncertainty is involved? What may go wrong? The same questions are involved. Therefore, the basic idea of the valuation is still valid, but projections are very difficult to make. So, what do we do in this kind of situation? Okay, do you have any idea? Can you go back and participate again here? What kind of the methods are used for a startup valuation? Are you aware of? Because most of the VCs or angels, they are putting their money in the startups. So they are doing something to value them despite of all the uncertainties. So how they navigate in this uncertain environment? Or if you are an entrepreneur, you are a startup, how you should expect it? What kind of the valuation you should expect? What makes your company valuable? Yeah, teething issues can be. Yeah, you are talking, yeah, about the problems they face. Yeah. So potential revenue generation and growth rate. This is the most correct answer. But the problem here is, as we highlighted, these are the real variables. But the problem is a lot of uncertainty associated with them. Lot of uncertainties associated with the growth and the revenue generation. That
So
is the problem.
background IP and all those things has to be checked.
Yeah, that's right. So if I'm a VC, if I'm an angel, I will have to go through what is known as due diligence very thoroughly, because any mistake can cause a great, loss to me. So I should be very careful about the valuation, right? Okay, so there are different methods, in fact, the industry uses. You can classify those methods into qualitative methods and quantitative methods. Quantitative methods will go into the detailed calculation of future revenue, future cost, and we'll make different scenarios also, and we'll ask the question, what is the likelihood of those different scenarios? Because of uncertainty, we cannot rely on one kind of the model. We will have to think differently. We will have to think what different things can happen, what different possible states are there, what different scenarios may emerge. And then we'll have to aggregate those scenarios together as one of the method, which is known as probability weighted expected return method. This method talks about thinking about different scenarios, or the kind of the flexibility there, because all the investment will not happen in one shot. We can invest our money gradually in many installments, so that kind of the flexibility is available to us. We can wait after first round to result, and based on result we can decide how much money we should invest, or we should invest or not in second round. So the real option will also is also involved. So we'll discuss about these quantitative methods. But believe me, when the surveys are conducted among the VCs and among the angels, how exactly they decide? So most of the times, rather than going into these quantitative methods, they rely on qualitative methods. What happens when you are facing huge uncertainty in your life? Rather than becoming a Bayesian statistician, going into probabilities models, you go with what is known as rule of thumb. You try to think simply, because in most of the cases, sometimes the simple is the more robust method of decision making. So many VCs use very simple methods or qualitative methods. For example, they can go with the checklist method. What is checklist method? They make a huge checklist. For example, what is the strength of management team? So they will ask the question, how much qualified are the management, is the management team highly qualified? Do they know the technology? Do they have any experience of a startup earlier, or they are the first generation startups? So they will make a list of the questions, and there will be yes, no answers of all these questions. Depending on how many questions are affirmatively answered, they will give them some weight. And those scores are then multiplied by the weights of that particular component. For example, management team is given 30% weight. Size of the opportunity is given 25% weight. So all the weight will sum to 100. And then the checklist, on the basis of the checklist, answer to in the checklist, they will give the score to each startup, and then multiply these two, they will get weighted scores. And this is the sum of the weighted score. And then they will decide, if my benchmark valuation is 5 lakh, that means if this score is 1, I may give up to 5 lakh to this business. So then how much I should give to this particular business? They have scored 0.78. So 5 million multiplied by 0.78, so 3.9 million. So this may not be very mathematical method, but still workable method in the environment where the things are very uncertain. The startup is just starting. They have not yet gone into in the market. They are at the conceptual stage. At that kind of the stage, this kind of the methods may work. Similarly, another method is scorecard method, where rather than going into the checklist, they give the score depending on the quality of every item. They give the score. 100 score means they are comparable with some benchmark in the mind of the venture capitalist. A score more than 100 means this is better than the benchmark. A score less than 100 means it's not at par with the benchmark. So depending on that, they will give the scores. The scores are multiplied with the weights and then get the relative score. And this relative score is then multiplied by the valuation of the benchmark. And that gives the valuation of the target company. Now, another similar kind of the method is what is known as Barthus method. A very simple method. In this method, the investor decide how much to finance to a startup, and this is particularly useful for very early stage startups. Depending on if their idea is sound, then 0.5 million can be given. If they have a successful prototype that has reduced the technological risk, another 0.5 million can be given. If the team quality is good, satisfactory, another 0.5 million can be given. So this kind of the checklist they use. Or another method, which is known as VC method or the venture capitalist method. What they do in this method, they try to think about the future case scenario after 5 or 6 or 7 years when the venture capitalist will exit from this business. What kind of the valuation scenario may emerge at that point of time? Because today there may not be any revenue. There is no growth, no market, no cost, no margins. But they try to imagine what kind of the business scenario will emerge after 5 or 7 years down the line, and the value the business at that point of time, and then translate this into the present. For example, suppose after 5 years we want to exit. Our valuation say that after 5 years this business will value 50 million if the things happen as per our plan. And I need 10x of return. Now, generally they target very high return. Why? Because they are facing so much uncertainty, so much risk. So what happens when the risk is high? Risk will inflate your R, the discount factor or the required rate of return, because the risk is included there only. So 10x in 5 years, a huge, return the venture capitalist is demanding, and that will be the case in the kind of the scenario we are talking about. So 10x return means that today's valuation is 5 million. And I'm going to invest here 1 million. So post money valuation is 5 million, pre money valuation is 4 million. And I want here 20% ownership. That means I will invest 1 million out of 5 million. I will have 20% ownership in the business. So this kind of the model sometimes venture capitalists use. So you will notice in these models are not going into much detailed mathematics or much detailed assumptions about the future, because that is too uncertain at this point of time. Okay, then there are quantitative methods where we really consider the future scenario. And one of the method, which is known as probability weighted expected return method, which is supported by international private equity and venture capitalist valuation guidelines also, is this. What we do here, we think about different scenarios. So we will have one exercise at the end of this presentation today. We will be using this method for a valuation of a green business. So we have different scenarios. So suppose there are 3 different scenarios: a successful exit, a moderate exit, or no return. And then we give the probability to all these scenarios and what will be the valuation under these scenarios. And then we multiply probability with the value and find out the expected valuation today. Another important aspect is the real option. So what is real option? Look here, and in the startup, we do not invest our money in one go. Rather, we can divide our investment in different, tranches or stages. If the first stage is successful, then only we will go for second stage. If second stage is successful, then we will go for the third stage. So this makes the investment in a startup like a buying an option. If the option is successful, then I get the money. If option is out of the money, then I will go get nothing at all. So if that is this is the way how we look at the investment in the startups give some value due to the flexibility they provide. So what I will do, I will show you one example here. Suppose there is a business where we have to invest 400 crore rupees. But we are not going to invest 400 crore rupees in one go. We will first invest in a pilot plant where we will invest 100 crore rupees. And if this pilot project remains successful, then for scaling up, we will invest our money in a commercial plant where another 300 crore rupees are required. Now, our today's assessment says that there are 60% chance that our pilot plant will be successful and we will go for second stage financing. 40% chance is there. The first stage will be not successful and we will terminate the project there only. If it is not successful, then the present value of our investment will become zero. If it is successful, then the present value of our investment is 800. That means that this 800 is coming from both the stages. Now, how should we look at this? If we go from traditional viewpoint, in the traditional viewpoint, we consider both these investment in one go. So we are investing 400 crore rupees. And there are two scenarios. Either we are successful, we get 100 crore. We are not successful, we get zero. The probabilities are 60%, 40%. If we calculate the expected value today, so 60% of 8 crore multiplied by and plus 40% of 0 is 480. So 480 is the expected cash inflow and 400 is our investment. So our net present value of this investment will be 80 crore. But we have not considered the flexibility part here. We have not considered that we need not to invest entire 800 crore. If the project is not successful, we can terminate it at the first stage only, and we will not be investing entire 400 crore. We will be investing only 100 crore there. So if we consider that flexibility part also, then how we should decide? So things are like this. In stage 2, stage 2, what will happen if we are successful in the first stage where the probability is 60%, then we will invest 300 crore in the second stage and our present value will be 800. Present value of the cash flow will be 800. So the second stage net present value is 500. And if first stage is unsuccessful, failure, then we will not invest anything. So the present value is 0. Now think like this. If the second stage is successful, we are investing 500. The probability is 60%. 500 into 60%, 300. If the first stage is not successful, we are not investing anything. So no investment is there and no cash flow is there. So the net present value coming from the second stage is 300. Now, in the first stage, investment is 100. So we subtract this 100. So net present value of the project will be 200. So if we consider the flexibility we are getting in the multi-stage financing, and we can terminate the project before we go for the second stage, then we discover that the net present value is 200, not 80. So this is the value of flexibility. This can also be looked as a, as a uh, call option, and can be valued using Black-Scholes model. But I will not go there because that is only a more theoretical proposition like rather than the practical proposition. From practical point of view, we should think about the value of the flexibility that we get in valuation of the startups. Okay, so I will leave this Black-Scholes part. Okay, so this was the evaluation of the startup. Uh, so to sum up, valuation can be done using qualitative and quantitative methods. Qualitative methods, despite their, they are not so academically or so theoretically well sounding. They are more in use because they are more robust in the kind of uncertainty we face. Discount rate is kept for startups very high. And due to very high risk associated with them. So now we move to green business. So I ask you the question. We go to the same question with the beginning, and this time I need your response. So we saw Tesla's business is manifold bigger than, Toyota's business is manifold bigger than the Tesla's business. While Tesla's total revenue last year was 98 billion, Toyota's business was 305 billion. But the market valuation of Tesla is many, many times. Look here, 1,450 against 250 of Toyota. What explains this? Yeah. Sumil is saying business multipliers are higher in green base. Good. Balaji is saying huge technology advantage for future. Arun is saying investors' perspective with Tesla is more positive. Yeah, but why? Why investors are so positive about Tesla? What is making them positive? Market potential. Market potential for what? Both are making cars. EV. Future society's expectations, right? EV industry is still nascent. So, but nascent means a lot of uncertainty, no? So uncertainty should reduce the value downwards. Carbon credits in the Tesla's balance sheet, the future shift toward the green tech. Yeah, so most of you are sounding the same thing. This is because of the green business. So green business creates value. This is what you are saying. So what is making Tesla so valuable? Growth expectations of EV business, as you said, ESG narratives, clean technology, access to cheaper capital, extra, and people are particularly driven by two stories: the technology story and the green story. And they see huge potential for this green business, right? While the Toyota is seen as a conventional business. So my question is now, what creates the value in green business? Why green business is valuable? What is the source of this value? So source of the value, look here, people, it may sound too rude, but people are not caring for, green business per se. There may be some people who care for green, but most of the people are there to make the money. So do they see the money making proposition in the green business? And if yes, what is the source of it? How green business can create, how green business can create the value? Yeah. So carbon credit in Tesla as well and said, yeah, okay. So I think we have reached to the time limit also. So yeah, so I will have to conclude it. So look here, there are many sources of the value creation in the green business. For example, the market-based sources, revenue-based sources. For example, the premium price, green premium. Consumers are willing to pay more for eco-friendly and sustainable product. New market opportunities, for example, growth in the revenue, renewable energy, carbon neutral products, EV, as you talked about, and the carbon credits and incentives. There are cost efficiencies also. We save the cost. For example, waste minimization, circular economy, operating efficiency, tax benefits, supply chain optimization. These will save our cost. Risk mitigation is very strong argument. So we can reduce our risk by making our product reputed, by enhancing the reputation of our brand, by hedging our climatic and environmental risk, and minimizing the regulatory risk also. If we are not compliant with the regulatory measures, we can face those kind of risk in the future, but the green business has no chance. Then stakeholder engagement, employees prefer the green business, stakeholder prefer the green business, and access to the cheaper capital. For example, the yield rate in the green business is lower, which is known as the greenium. Cost of capital may be low because there is low systematic risk associated. Availability of fund is there. So the value implication of all of these is the green business have premium. It will increase their revenue. It will reduce their cost, and regulatory cost will come down. Discount factor will also come down because of risk mitigation and the kind of the flexibility that is available in the green business, which can be captured through real options that can also enhance the valuation. That's good. But there are also landmines. That means there are some dangers also associated with green valuation. For example, the regulatory ecosystem is not, stabilized. It may change. So regulations, the subsidies, taxes, extra, these policies keep changing, which may make the environment more uncertain. We need permissions, compliances, which may delay the project execution. There is a lot of uncertainty and the volatility associated with the carbon credits. Operational risk is there because most of the time the technology is unproven, and this is immature technology. Capital intensity is very high. Supply chain may be constrained. For example, we have recently seen that the rare earth material supply is very limited globally, and if you are too much dependent on these inputs, you may face the risk. Market demand is also uncertain. We may overestimate the market demand. And most importantly, there are the incidences of the greenwashing also. Greenwashing means there are misreporting also happen. So as a investor, we should be very, very careful, and we should go for our compliance procedure very strictly. So these all the aspects reduce the valuation. So there are, of course, there are, there are reasons to believe that green business create value, but as an investor, we need to be careful. Okay, there may be green hypes also. For example, in the market we have seen there are different types of the hypes. For example, dot-com bubble, housing bubble, we have seen startup hype, we have seen. So there is a concern. Are we going through a green bubble? Everybody is talking about green. So the kind of the valuation we see in the green business, is it for real or it is some kind of the bubble? In fact, I should now close it. So should I close at this point of time with this question open to the participants? Okay. So this is an open question for you participants. Think about this. Is the green valuation we see in today's business, today's market, is it for real or is it some kind of hype? And to what extent it is real? And to what extent is it influenced by the hype? And if we are a green entrepreneur, how this hype may infect us? Why should we be careful about this hype part? And if we are an investor, what can we do about this hype part? So that is an open question I leave for you. So with this, I will close today's discussion. Thank you very much for joining.